This is the Domain Magnet Show, where you'll learn everything you need to know about buying, optimizing, and selling online businesses with your host, Michael Beroslavsky.
Welcome. On this episode, we have a special guest, Ian Reynolds, head of venture partners at Golden Section. Ian has done quite a few transactions on the VC and the PE side, and has been involved in billion-dollar transactions, and has also acquired and sold multiple companies in 7 and 8 figures. Hi, Ian.
Hey, how's it going? Thanks for having me.
It's good. Yeah, I'm excited to get into it because we've been chatting for some time now through our mastermind, and I was always curious about like your stories and businesses that you buy. Because I noticed that your approach is actually very similar to kind of how I look at businesses, except you just target businesses that are quite a bit bigger.
Mm-hmm.
So yeah, I'd love to hear how you got into that. First of all, what was your first introduction to buying businesses?
Sure. So let's see, 2016 or so, I had a friend that we played college soccer together. He was a couple years ahead of me, and we just were playing, catch up. Hey, what are you doing? What are you up to, et cetera. And he described for me post MBA that he was in an incubator that helped him seek and acquire businesses in the United States. And he said, you should look at this. This is something that I'm able to do. And I thought, this guy's got 2 more years of experience than I have, and he's buying a business. And what does that mean, right? And he explained, well, I'm going to buy the business and I'm going to run it as the CEO, and I am going to grow it and then sell it, and walk away with $10 million and retire, and if he can grow it at a certain rate, et cetera. And so I was like, okay, well, that's interesting. How are you going to do that? And so he sent over some resources, and that sort of opened a can of worms in terms of my perspective. And I had to spend 6, 8, 9 months reading about how to do that. And all the while I was working actually in transactional finance.
Okay, so that's 5 years ago. And before that, what was your background? What were you doing?
So before that, let's go early start to my career. I was in startups, not my own, other people's startups. Learned a lot of what not to do and how not to run things. And so did the MBA, an accelerated program, finished it about in a year, and then moved from Dallas. I was in Dallas, Texas. From Dallas, Texas to Houston, and worked in energy transaction advisory and some large energy software projects in a very, very boutique consultancy in Houston, and like so many firms in Houston in the energy space, right? So we served upstream, midstream, downstream oilfield services, just a wonderful company. And so I had the opportunity to do both these really large enterprise deployments on the software side for some private equity backed firms, where we'd go in, private equity firms would put in a bunch of money, and they, let's say, bought a refinery, and they need to install like enterprise trading risk management software or something like that, and then scale it up. So we would go in and do that sort of stuff. And then after 1 or 2 of those projects, I moved over to the transaction side, where companies were buying and selling each other, or in some cases they borrowed too much money and they needed to restructure, meaning, the banks were saying like, hey, we gotta make whole on this debt, and we need somebody to help us. So we go help the banks kind of sort out that problem, if you will.
Very cool. And so that's where you worked on some billion-dollar deals as well, right?
That's right. Yeah. So we had the opportunity to do some very, very large transactions where we were either representing the bank, or we were representing the company, or we were representing a potential investor. And they were either looking to acquire assets or sell assets or make a loan to these against these assets, or, as I said earlier, restructuring. So restructuring was probably one of the most fun set of tasks that I had, where these companies that they had several hundred employees, and then you had to whittle it down to like 2 or 3, and then try to operate the assets with that, and get the bank's money back, and then turn around and sell the asset or sell the company and sort of rebuild it post getting rid of all this debt, because the debt would get converted to equity. And a quick side story on that: there was once a company that I helped restructure, and it was like a legacy company, had been around for like 100 years, well respected, well recognized. All the employees had been there for, in some cases, generations. And this guy just like tanked this company as CEO. And so we had to go in. He was a pretty bad actor, and get rid of him. And just had to like move all these files out of this multi-story office building in downtown, like ship them off to like a foreign site so we could go through them. So we had some fun places, but I saw parts of Kansas that I never wanted to go back to, so that it sparked my interest when my buddy said, "Hey, I'm buying a company."
So was it like in oil and gas? Yeah.
Yeah. No. So the friend of mine that acquired a company, and he's still running his firm, and he's doing quite well, and he's done many bolt-on acquisitions, was in the wine and spirits space, which is something that he was super passionate about. And so they're doing super well. I mean, he's recently bolted on a couple more things into his platform, and they continue to grow.
All right, very cool. So then you learn more about acquisitions, and is that when you quit that company and moved to work for a venture partners for Golden Sections?
Yeah. So what happened was I was in this really boutique sort of consultancy, doing these transactions, and we were coming to the end of a very large transaction cycle. Energy is very cyclical, and I'd spent probably, in addition to this time period of doing this work, maybe 9 months reading about transactions, how people were doing them, especially in the size of the kind of like entry-level transactions, if you will, and really kind of got a sense for how people are doing things. So I stood up an LLC, got sort of insurance and formal documents to protect myself, et cetera, and started just kind of networking aggressively around town, and with business brokers, et cetera, and other folks who were doing this type of activity, to get a flavor for what folks were doing and sort of what transactions were available. Talked to a large number of business owners, and ultimately had a buddy who I was introduced to through a mutual contact, and we said, hey, let's do a deal. And so did that deal and moved my family from Houston to Salt Lake City. So we closed that transaction in September 2017, and moved my family up to Salt Lake City. We were up there for 3.5, 4 years, and we grew that company from just it was a handful of employees to quite a large number in a short period of time. Improved profitability. Probably the most important thing is we talked to a bunch of research firms, like Gartner in the United States is a big research firm. We talked to we conducted a market research study actually through my university to get some information on how we should position ourselves, how we should position pricing, how we should position the firm overall. And through the combination of this research, we hit on a couple ideas in terms of how to be, you think, Michael Porter type differentiation. And we made some pretty big adjustments in the business model really quick. Took probably about a year to make those adjustments, maybe a little bit longer. And then we started growing pretty rapidly and adjusted our prices, et cetera. So then December of 2020, I had the opportunity to exit that business. And so now I still advise the business in sort of a board capacity. And I moved back to Houston with my family. And so now I am the head of venture partners, and I'm happy to talk about that. And I am also the chief strategy officer at a data analytics firm. And on top of that, I do investing through Thesis. So where would you like to start?
That's very cool. So that first deal, you spent about 9 months kind of learning about deals and interacting with different people, trying to find opportunities. So tell me more about that deal. What was like the structure? How did you finance it? How big was it? Like 7 figures, 6 figures?
Yeah.
something
So
like that.
yeah, seven figures. We're definitely in that range, right? So typically when you're looking in a let's call it a search fund style, which is sort of what this deal was. Those transactions are typically in the realm of, let's call them 10 to 12 million revenue type businesses, and they're earning anywhere from 1 to 2 million. Typically, the search funds are looking at EBITDA. I personally prefer to look at free cash flow, right? What is the cash that comes out of the business after maintenance, capex, et cetera, and what is the rate at which that's growing, and also that operational cash flow is reinvestable, and so basically like you have this 10 million revenue, and then about $8 million worth of costs, sort of in there. Is a typical transaction size.
Okay, so it would have a bit of like 1-2 million.
Yeah. And then in terms of transaction structure, like the transaction structure in lower middle market, I'd say, is pretty uniform for most of these deals, with some variance occurring between each of these components of the capital structure. So you have like a third of it is going to come from financing from investors, right? And they'll typically get a pref. And then you have a third of it is going to come from market debt, where a bank is either going to say, hey, this is a blue sky loan, or and we'll give it to you for maybe 5 to 6 years, 5 to 7 years, depending on if you're doing like SBA, and then SBA sometimes goes up to 10, and then other first lien lenders may look at it depending on assets and other things and say, yeah, we'll also give you a first lien loan, maybe some mezz in there, and that's another third of the capital structure. And then the last third is typically seller financing, where you have the seller basically providing a note that is, think of it as sits near the bank debt, but typically bank debt, it will typically almost always has priority over seller financing.
Okay, very cool. So for a $1 million EBITDA or 2 million, what would be the typical price? What would be typical like multiple?
Yeah, so I'd say historical multiples for these kind of lower middle market search funds have been around, it's called 4 to 5 of EBITDA.
Mm-hmm.
But I would say that's crept up, especially as people have moved towards software. They've paid much higher multiples, in the realm of like 6. I saw one that was as high as like 7.5 recently, which I don't think I would have paid, but that's what some people are paying. So I'd say multiples have crept up, especially for software type businesses or asset light businesses, into that 6+ range.
Okay, and that first deal, was it software type business? Was it heavy on software?
Yeah, so we were a service business, and we eventually stood up our own SaaS platform.
Okay.
And then also transitioned to much more of a model where we had, let's call it like service contracts within the service. So it had elements of a kind of recurring revenue business, but insofar as we had, so typical B2B SaaS business that is got like a sort of ideal contract structure is going to have contracts that are, let's call it 2 to 3 years in length. And so we took that idea and applied it to our service business. And and there are other service contracts that do this in the software maintenance space. And then we structured sort of software maintenance contracts around some of the services we sold. And that resulted in really sticky revenue, right? Because they were contracted with us for 2-3 years. So like,
and
couldn't go away.
And so how much of your own capital did you actually have to put in that first transaction?
Too much.
Yeah.
So I will say I put probably a third of my net worth into the transaction, which in retrospect, I'm not sure I would have done again. It worked out fine, but thinking about it after the fact, it was a lot of risk.
There's a lot.
Yeah. But I'd say typically actually in the lower middle market search structures, you don't necessarily need to use your own capital. It was almost unnecessary that I used any of my own money, because if you find a transaction and sponsor it all the way through, maybe you do pay for the legal fees and the accounting fees, etc. it's not even necessary that you necessarily even commit a serious amount of your own capital. Maybe there's a little bit down payment for the debt that the banks want to see, but you can walk away with, in some cases, up to 60% of the transaction without, if you're in that kind of like sub 10 million range, without using too much of your own money.
And what other financing did you use? Did you get an SBA loan for this deal?
So in our case, it was, kind of like very similar structure to Search, right? So first lien type stuff and seller financing, right? So no SBA debt.
And how long is, like, what time period is the seller financing usually spread around?
So typically seller financing is shorter than bank debt. So again, a bank debt, you're looking like 6 to 7 years on something that's like first lien. So seller financing, you're typically looking like, let's call it like around 4 years, 4.5 years. Okay. Depending on the transaction structure, and if you have different hurdle rates, et cetera, you can stretch that, right?
And you can pay it all from the business profits generally, yeah?
That's right. That's right.
Okay.
And typically that's in the US, if you're going to do it, depending on your transaction structure, if you have the seller retain any sort of equity and they stay like a partner in the business, it's going to be like pre-tax, right? If you structure it as like a formal note, it can be post-tax to a certain degree. But in most cases, I think especially for these smaller transactions, people are rolling their equity. So you have a pre-tax component to that. So you have to keep in mind that, like taxes are real costs to the business. I wish they weren't, but is what it is.
And did you have any investors in that deal?
I did, yes. Yeah. So I had a number of folks that I talked to in, let's call it the traditional search space. But ironically, they weren't necessarily fits for this deal. And I was like, there's great opportunity here. Like, why would you not invest? And they just said, like there's 50 million things wrong with this thing. And so none of these people opted to invest with me. So I did it without them. And that has pluses and minuses. I'd say the people in the search space are pretty well defined, and there's new entrants all the time, and they're very sophisticated and very smart folks. I keep up with a number of them, really just great people. But this deal, because of its characteristics, was not a fit for the sort of like set of criteria they typically invest in.
So was it like one of those that's slightly on the riskier side, like has this impression that it's a little bit riskier?
Exactly.
That's the ones that I usually like as well.
Yeah. So like, but the opportunity for me was clear, and I understood the dynamics of the business and how it could be improved. I confirmed those things with confirmed and improved my opinion on those things with some of that research I did, but it was very much like too much in the periphery of what these guys would traditionally invest in, right? Which is funny because like I haven't seen any deals similar to what I did yet, and I would do another one in a heartbeat, but we'll see.
Very cool. So you mentioned the term search fund. What does this actually mean?
So search fund is a set of individuals who set out to acquire a lower middle market business. It started mid 80s there's a group at Stanford that went to a professor and said, hey, we want to buy an existing business rather than start our own. How do we do that? And so that's when the search fund was born. So there's a Stanford search fund study. I recommend you just go to the Stanford EDU's website, pull that down. You can read about it. And it's got all the data. Basically, they've done a retrospective study going back to 80 something, and kind of tracking these people who've done traditional search. Now, in contrast to the percent equity that I've talked about in terms of what these people can walk away with, a traditional search is where a searcher is going to raise money from investors first to say, hey, I'm going to pay myself a little bit of a salary. I'm going to go run around town and try to find an opportunity for me to invest in. And if you let me, you go sell units to 15 or 20 investors, maybe you raise a total of $500,000 for one person. You spend half of that on, searching for an opportunity. The other half is maybe salary and just other sort of things. Maybe you have some reserve left for dead deal fees. And the idea is you give those investors a promote on their equity. They also get the right of first refusal on the transaction that you generate. So they could say no, but their equity then converts at a premium into the transaction. And as a result, they also command much more of the equity. So typically a traditional searcher is only walking away with something like 10% of the company day one, and then up to 30+% of the company after certain internal rates of return are hit for the investors. So traditional search, you sacrifice economics for a bit of safety, and whereas I'd say the persons who do like what I do, you can walk away with as much as 50+% of the company day one, right? That's very common.
Yeah, that makes sense. So that's yeah, and then did you do something similar? Did you raise some capital from investors first and like pay yourself a salary when you were looking for a deal, or did you skip that? You did?
No, fair question. So I had that formal structure set up. I had a PPM. I flew to the East Coast, flew to the kind of Midwest, was in the process of visiting some people in the Mountain West. And at the same time, I had found this transaction. And people, again, the traditional investors was like, hey, look, I found this deal. Like, will this be interesting? Some people were like, no, not a fit. So I had like half of my units committed, at least verbally. And so I said, well, okay, I don't necessarily need to give up my economics for a deal that a lot of people don't necessarily want to do. So I'll just do the transaction myself. So in the process of raising that, I also completed this transaction and then said, hey, thank you very much for your support in the process of raising my fund, the traditional search fund. But ultimately, I've decided to go a different route, and I'm glad I did. Because
did you have to refund the investors? So
I was only at the stage where I had verbal commits for half of my units. So I hadn't officially. Basically, typically the way it works is you raise all your units, or 90%. It's typically all of them, and then you kind of like pull the capital down at one point once you get the commits. So I was again parallel processing. So I had the transaction I was doing on one side at the same time I was raising, and I was asking people like, hey, would you do this deal? Would you do this deal? Would you do this deal? I got a bunch of no's, and with like, well, this deal's like super gonna happen. Long story short, I did the transaction without the investors and shot them a polite email. I got only one person who was like super mad at me. Everyone else said congratulations. And I've stayed in touch with pretty much everybody else. Actually, no, that's not true. I stayed in touch even with that person who was mad at me.
Very good.
Yeah.
Very good. And so usually you said you would get 10% in the beginning. So because you put more of your equity, you probably got like more than 30%, yeah, of equity.
That's right.
But you probably didn't have like an opportunity to increase it because you didn't have investors, right? Or did you still have?
No, I still had investors. We still had debt. We still had
seller finance.
The traditional structure. The difference being that because I didn't do a traditional search fund, I didn't sacrifice the economics to those investors, right? So the idea of a traditional search fund is like you limit your downside because you're paying yourself a salary for these investors, and so they say, okay, well, because of that, we'll comp you a certain amount, but we take a greater percentage of the economics. Effectively, if you look at the traditional model versus the self-funded model, I was effectively a self-funded person. The traditional model says that the let's call it equity economics, et cetera, of the capital structure work out this way, where basically the debt and the equity that go in from the bank and the investors basically flows to the investors, and the seller financing, in theory, goes to the searchers, right? So that seller financing be a third of the capital structure.
Searchers meaning the like you or
the person like me, and that's how it would typically happen in a traditional. Whereas with the self-funded, that is people like me,
Yeah.
who go and do the deal without having equity in advance, they get the economic benefit of the debt and the seller financing, right? In addition to whatever equity they put in, right? So that's why they can own, like 70+% of their transaction, in contrast to, self-funded, or sorry, a funded searcher. So.
Yeah, makes sense. So yeah, basically then the idea is, if you are new to the space and you have quite a bit of experience, you understand deals, but you don't have the capital, then that's probably the best option. You go and raise a search fund, you talk to a bunch of investors. It can be really time consuming, and you have to grow your brand, develop relationships, but then you get all the capital you need to go and find a deal and acquire it. While if you already have some well-established name, reputation, capital, then you probably don't need to do that. So you can just skip that and then also save time on talking to a lot of investors and sort of go straight to finding some deals, finding some financing sources. Yeah.
Very much so. Yeah.
All right. Very good. Yeah. So then let's get to the good stuff. After you acquired that first business, what did you do sort of in the first year or so? What did you accomplish in terms of growing profits? And what are some changes that you plan to make and made right away?
Sure. So we had to transition a number of people out of the business to professionalize it. So
sorry, how many people did it have, like, in the beginning? What was the team size?
So like 30, or maybe like 40. Yeah.
All full time, like local, in the office.
Full time, and we had some people who were remote, etc. And the challenge we had was that the resources we had were somewhat limited, and we had to improve the quality of the staff pretty aggressively. And so we had to transition sales resources. We had to set up accounting processes, right? There were no sort of formal accounting processes. Like the seller, for example, was making accounts receivable calls himself, type things, right? And so set up accounting processes, get the books cleaned up. We actually had to fire the company CPA and go get a new CPA and clean things up, which was a chunk of work, believe me. And I mean, we knew the books were clean. There was no issues with the books, but we had to do that work.
That's perfect, because that's like tied to your background here, like finance and accounting and understanding numbers.
Yeah, exactly.
So that's probably easy for you.
It was pretty straightforward, and it was a simple business, so it didn't require a lot of work. And then it was, okay, we got to evaluate what we're doing on sales, right? We'd hired some junior employees who have since gone to do wonderful things, but were not appropriate for what we needed to do with the business. And so we had to evaluate hiring new sales resources. We had to train up some internal project managers. And so actually that was the one case where with project management, as opposed to hiring senior people, we chose to hire junior people and train them up because we had that competency sort of in spades internally. And then, so in sort of addition to those things, we were conducting this research with Gartner and universities, et cetera, to see how we should position ourselves. And we started talking to competition, et cetera, in the market. And that led us to certain conclusions about marketing and sales and what we should do in that arena, which I can't 100% divulge, just otherwise we give up our competitive position. But that was super helpful. And there was also, like, another example is like there was no marketing at all in the business. It was all word of mouth and outbound sales. That was it, right? There was no marketing. So we had to stand up an entire marketing function within the business. And that in the digital age is competitive, right? But we did that. Eventually that marketing team got up to like 8 people. It was pretty large.
Was it all B2B? Like large transactions?
Yeah, all B2B. And so it was that kind of like those series of things, and then keep improving the team as we went along. We stood up some other offices hired a bunch of people, and like stood up our HR department. We have no HR department, right, formally, so we had to stand up an HR department, hire HR resources. First we had started like a pair of like people who were recruiting, then we trained them to do other things, and then so it was and we had I'd say a fair amount of turnover through that period, and then it sort of stabilized. But we sort of knew that that's what was going to be required to get things done, and those series of changes, right? Accounting, marketing, sales, et cetera, all kind of each individually added to the bottom line, and so those things kind of stacked, and we were able to just kind of like build that reinvesting machine in the business.
And so, was it like a full-time job for you at that time? Like, were you the CEO?
Yeah, it was like 6 a.m. to like 6 p.m. minimum, and
for a few years.
Then I would, for a few years. Yeah, I mean, I was full time on that. Did nothing else, and because it took a lot to let's call it to transform that business, and but I'd say it normalized pretty aggressively in 2020. 2020 actually wasn't a bad year for us. It was it was a bad year generally, but it wasn't like terrible, right? We didn't have a hard time. We actually still grew through 2020, and actually business got a little easier to manage because we'd completed many of the things that we tried to complete in the year before. So it wasn't quite such a crazy time frame.
So did you sell it before COVID?
No, actually. So it was December of 2020. Yeah.
And so, just briefly, in those 3.5 years or so that you've owned it, what did you accomplish? Did you like double, triple the revenue, profits? What was the number of stuff at the end?
Yeah. So we're a private company, and I'm still advising the company, so I had to be careful with what I say. Okay. But we increased revenue materially. We increased. We increased profitability by let's call it just year one alone. It was like 30 or 40% within like 3 or 4 months. So part of that is like changing our pricing, which had never been changed for 10 years. So because the business had been established for 10 years prior. So yes, I mean, and we were able to do that basically every year through my tenure pretty aggressively, and all the while getting better and better staff, which was the probably the key to success was getting better people on the bus, because it just meant that like, hey, if I got a really trusted marketing researcher who can do what it is that I used to do to prove this thing out, once I brought that person in, okay, I trust that person. Great. Like once I prove out something on sales and I've got my sales resource in there and I trust them, okay, they've got it from there. Once I had my sort of HR manager, great. Okay, I don't have to spend as much time interviewing like every single employee. They'll take care of it, type thing. And eventually we just said like, on certain calls with certain of those resources, okay, I don't need to be on any of these calls anymore. Like, I trust you. Good luck, and let me know if you have trouble. And so that was probably the most important thing was getting the right people on the bus.
All right, very good. So then, what was it like running a more than $10 million revenue annual company for like 3-4 years?
One of the things I tell people is, you don't want the business to be your personality, right? You are not the business. You're not the same person as business. And for me, I think for the first, let's call it 3 years, like I was the business, and my identity was wrapped up in the business. That fourth year, I was able to realize like, hey, that's different. And in that fourth year, frankly, we were able to make some pretty material improvements. So I would say always try to have the perspective that, like you're bigger than the business, and your life is separate from the business. Because I was basically like a workaholic. I don't know how else to put it. So it was tough. Yeah. It was not easy.
Okay, and so I understand there are some tactical improvements you managed to make early on, like adjusting the pricing and maybe repositioning some things, letting go of some some unnecessary costs, improving the financing. But then there were also some major kind of long-term things to do, like developing some proper systems, improving marketing, like scaling up the personnel. Yeah. So would you say it was more the longer term changes that made it grow, or was it like the tactical, the short term things that really improved the most the
Yeah,
profits?
fair question. I think two things. It was first having a strong foundation, right? So there's certain things within a business that really are rinse, repeat. So let me see if I can repeat this. But I used to say something to the effect of like 95% of what you do in a business is repetitive, but it makes you 100% of the money. And so the idea was that we'd have to take these things that were really repetitive and improve them. So our entire accounts receivable department group team is basically run off of like 3 Google Docs, and that's it, right? If this, then this, if this, then this, if this, then this.
And that's
and also had,
what was the accounts receivable, so like all the revenue that comes in?
Yeah, so accounts receivable, like the folks who call clients and like do collections, etc.
Okay.
Like that's a process, right? And that process ran off of just like 3 Google Sheets. And like if we had trouble, we would just be like, hey, go back to the document on this thing, like edit it, add this piece, like so this problem never happens again. And we had several of those documents. We had it in sales, we had it in marketing, we had it in accounting. And so we'd build like a base layer for these processes so that like they'd break less often. Now they still broke, but they break a lot less often. And so I'd say the first thing was like getting those foundational things in place. The second piece was the positioning. And then the third piece was hiring, right? Sales, marketing, hiring. I'd say the positioning informed the marketing, right? We did some very serious market research. One of our studies took like 3 months, right? That we did. And because we were in a very, very competitive space. So we had to pretty materially differentiate ourselves.
And was it, did you have any overseas employees, like any remote people, or is it all everyone based in the US?
No, so we had offices everywhere. We had folks, a lot of people love like VAs, etc. We had folks in the Philippines for a short period of time. This is only like 2 employees. We had, but it was still helpful. And we had folks in India. We had folks in Latin America. We had folks all over the US. We still do. But in India, we even stood up an office over there because we had some great resources that we were able to find and hire. And so I think we're on like the third and fourth floor of like an office building down there, and the walls are all purple. And so we would fly out there pretty regularly. And
did you have to stay there for some time?
Yeah, I stayed there for some time, but we literally like renovated an office space from like, it was like dust and concrete to kind of like fit our brand. Okay. And took it from literally 0 employees in that office to I think it was like 50 or some odd when I was done with that particular office. And then I think we're needing to find some more space because we're bumping up to that one. And so yeah, I had the opportunity to travel over there, and it was a lot of fun.
All right, very cool. And can you share anything about like how profitable was it for you after you sold it? The money you got back, all the money, I presume. Did you like make a nice profit?
Yeah. So to speak about that, and I probably the best reference, the frame of reference is the search funds, right? So search funds have sort of like quartiles of return, and I was in the top quartile of returns, which is, I'd say, abnormal. And I mean, I'm frankly kind of lucky. There's a certain element of luck in business. And if you look at the distribution of search funds, right? So of the, let's say 100 people go look to, and this is in traditional search, right? So it may be different in self-funded. In traditional search, if 100 people go acquire a business, or 100 people go look to acquire a business, something like 70, 75 or so will actually be able to acquire. Of the 75 who acquire, a third of those, or well, not a third of them, like 30% or so will fail, like the business will fail. And then the rest of those will go to generate returns, right? And so the return quartiles are something like, for the people who actually generate a return, is something like 1x your money. Then the next quartile is like, like roughly 2x your money. Then next quartile is like, 3 to 4x, and then 5+. And so I was in the 5+ category of return. And so you can look at that in terms of like what people would generate on a search fund scale, and that tells you everything you need to know.
And that's over the period of like 4 years, yeah?
Over a period of 4 years. So I'd say a typical exit period for a search is like 5 to 7, right? So we also had a shorter hold period. And I think that had some idiosyncratic components of the business we were in and what we were able to do in terms of like take something that had wonderful potential to grow.
All right. Well, very cool. Thank you. That's an amazing story. So you found a deal, you went the traditional route, and then you didn't get enough interest from investors, so you decided to put more of your own capital. You had a plan, you executed it, you worked hard on it for like 3-4 years, resold it, 5x your money. Good exit, very good.
Mm-hmm.
And so that probably inspired you to go and do more deals like that now.
That is correct. That's the natural next step. So yeah, moved my family down from Salt Lake City to Houston, and you just talked to a number of folks in town, and kind of like had to rebuild my network in a certain respect, because I had taken so long to and so much time, energy, and effort poured into that business, that I kind of neglected my network. Which I would never recommend to someone, and I don't think I'm ever going to let happen again in terms of like neglecting a network, because it's so great to reconnect people, and they invite you to weddings and get free food and stuff like that. Anyway, so kind of ran around town, talked to a number of private equities and other firms in town, and had a friend who actually ran a competitor to the firm that we ran, and he had actually done a very similar structure, where in conjunction with that firm, he'd gone and bought companies, grew them, and then sold them. And then in some cases bought them back after the acquirer failed to run the business, and then grew them again and sold them again. And so he, borrowing from that success, had started putting together a venture fund, and he recommended I come talk to him, and long story short, so now I'm the head of venture partners at Golden Section.
Right. And by the way, so that profit, that sale of the business, the profit that you were able to generate, would you say that most of that is due to like deal structure and good financing, or would you say it's mostly because you were able to just grow the business, grow the profit, like specifically grow the profit, or would you say it's mostly because the value of the business increased, like the profit maybe didn't grow as much, but the value increased because you put a lot of systems? How would you attribute that?
Yeah, so for my transaction, it was all of those components. But for most people in the search space, the traditional model is such that you pay down that debt, and then you recapitalize the business, or once the debt is paid down, you're able to sort of take the cash flow out of the business. The business in the traditional search model may not be fast growing businesses, right? They maybe grow at maybe twice or a little bit faster than twice the rate of gross domestic product growth in the United States. So you're basically like, you have a safe, stable business, you're paying down the debt, and then you're putting maybe more debt on it. Think of it like a real estate refinance type structure. And that's the source, I think, of most people's gains across the traditional model. So again, I had a bit of an asymmetric outcome. And so it was all of those things that accounted for my value. But I'd say for most people, it's paying down debt.
And so also during that 3-4 year period, did you acquire any other businesses, or were you only focused on that one?
We looked at some transactions. We looked at a number of transactions, but for a variety of reasons, we focused on our core business, and I'm glad we did.
And since then, have you done some more acquisitions since you've sold
Yeah.
it past year or
Yeah.
so?
So personally, I have facilitated, let's call it like, I've done like 20 some odd investments. Okay. But of like, let's call it larger transactions that I've been a part of and helped facilitate, it's been about, let's call 7 larger ones where I've sort of materially participated. Net, it's been like 20 or so plus deals that I've been engaged with. I'm maybe a little more picky than most people. A lot of people will kind of spread their bets, whereas I want to do things that I really particularly understand. If I don't understand it, I just tell people really politely, be like, I'm very sorry, I don't understand enough about your business to be able to add value here, and I would probably lose my money, not because you're a bad entrepreneur, but because I don't know what I'm buying. So in that case, I had to turn over maybe more stones than most people.
Yeah, that's my approach as well. I get so many people approaching me with like different investments, opportunities, businesses they want to start. And I just have this rule that if I don't know enough about it, if I don't understand, I just don't get into it, because like every business has so many different complexities and you have to know so many different nuances. Yeah. It's important to like stick to your areas of expertise also.
That's right. And then I have friends that I've made as a result of sort of being in this community and investing with people that I'd be like, man, I wish I would have invested in this person's business. Or I found out after the fact and became friends with people after the fact, and I keep asking them, hey, let me invest with you. So I'm hopeful, and that some of those opportunities will occur.
And are those just passive investments, or do you stay involved somehow to some extent?
Yeah, so I have I'd say probably the majority of them are passive, but I take a more active approach in terms of like reaching out to people and saying like, hey, I'm noticing this thing in your financial statements, noticing this thing on your website. You know, maybe I'll call and pretend to be a customer and kind of get some opinions. And so I'm constantly kind of like testing the fence is what I call it. And I'll try to provide insights that way. And then also just be available. And if you're available for people, like it's hard being an entrepreneur. It's hard running a challenging business that you're throwing your blood, sweat, and tears into. And so I just try to be that sort of not shoulder to cry on. Most guys don't need to cry to anybody, but be a sounding board and share anecdotally what it is that I've encountered and how I dealt with those problems. And from my perspective, that's pretty valuable. I don't know if these people consider it valuable. Maybe Ian's just kind of got a little bit of an annoyance factor, but people do also call me out of the blue and say, "Hey, I want to pick your brain about this thing," and it's a lot of fun. I mean, it's the most fun in the world.
Yeah, that's a really interesting approach. So those people, they are just business owners, like business owners that you've contacted that you were looking at potentially acquiring, and then you ended up just like helping them, consulting them a bit for.
Yeah. Or it's folks who are doing the self-funded search, right? And they're looking to raise capital.
So people in the same industry who were finding some deals and maybe acquired the deal, and then you invested with them.
That's right.
Was that more common than just investing in like existing businesses?
Yeah, I'd say that is increasingly more common. I think before I was more like I kind of ferret out where I thought that there was going to be value, and now it's a lot of like, hey, who in my network is looking at these types of things? And so it's like 6 degrees of separation, and someone's going to refer me to somebody, and that's usually how it's happened more. And I think that's been more because I've been busy, but I've been just asking for it, and people like, hey, look at this thing, and that's kind of how it's kind of been more organic, which is my point about like don't neglect your network, because there's great opportunity there.
Yeah, absolutely. And how much would you usually invest? What's the amount you would put typically in a deal? How do you measure that?
Yeah, so if you look at, I try to some degree mirror kind of the traditional search model. And if you look at the traditional search model, those guys are putting up like, let's call it 100,000 to 250 in some of these deals. And so I try to mirror that when I'm sort of making a bet, with the idea that you get a collection of these things where you make sense. And I have 1 or 2 where they're higher conviction bets, and it's much more than that, of my own personal capital, right?
All right, very cool. And when you invest in an existing business, how do you structure that? How do you set it up?
Yeah, so mirroring that traditional search structure, right? Or in some cases, and this goes to the venture fund, et cetera. In some cases, there are clever structures where you're kind of treating it like growth capital, where you're doing a what's called maybe the seller's rolling equity, and that way they can keep more money in the business. The business isn't as debt laden as if you were to do sort of a full LBO, which is some of these traditional search fund deals do. And you do basically a kind of not a warrant structure, but debt with certain call provisions that convert to equity. And by doing that, you can unburden the cash flows of the business to really grow. And I think that applies more so to especially these SaaS type businesses that are capital light and really just need to pump money in to drive revenue growth.
So can you give me like a specific example, more or less, what it would look like? For example, a business that's like earning 12 million revenue and maybe like 1 million a bit to 2 million, and let's say you put $100,000 or $200,000. What would you get? Some kind of percentage of equity or some convertible note? What would it look like?
So there's a recent transaction. A friend of mine bought a business, and they're doing, again, it's kind of like third, like I talked about in terms of that structure. Again, with some varying degrees within that, but rather than do because the seller rolled a bunch of equity and kept it in the transaction because they trusted this guy to actually grow the business. He's actually really good track record, amazing track record actually. We did some of the equity as a convertible note. So we were injecting capital in the business that was available for them to use, knowing that it would convert to equity. And we because they were going to continue to grow, or at least that's the hope. That's they're going to continue to grow, and they're probably going to potentially actually raise capital, which would dilute us a little bit. But we're doing that structure because they have a really high, what's called sales efficiency ratio, where every dollar they invest in sales and marketing, they get, X many dollars back, or $1.20 back. And it's best for us if they continue to grow with extremely limited amounts of profitability, because in, let's call it 3 to 5 years, they're going to have left the competition in the dust, right? There's going to be no competition, or there will be competition when there's competition now, but it's going to be hard for that competition to compete unless they go raise significant amounts of capital. And even then, there's kind of a time delay in terms of what they're doing. So that case is maybe a little bit odd in terms of that deal structure, where they have a growth trajectory which is like abnormal.
All right, very cool. So what do you look for in an ideal deal currently?
Well, again, so something that I understand. But I would say the most important thing for me is I'm looking at free cash flow. I'm not looking at EBITDA. I'm looking at free cash flow, and I'm really trying to understand what the CapEx needed to maintain its market position is, and what its ability to reinvest return on incremental capital is, right? So if it's going to keep money in the business, how efficiently is it going to turn that capital to grow the business? And I pay attention to very little else, because if it passes the filters of something that I understand in terms of like the type of business, then I'm spending 90% of my time really understanding its how it's efficiently using its capital, because that means I also understand the microeconomics of the business. It's not typically a commodity business. I have a couple bigger commodity type business investments that I made that are in the software arena, and I don't think I'm going to ever do that again. The investments have been fine, but the problem is that they're easily competed away.
So you're looking more at capital efficiency, how efficiently the business is used. That's kind of one of your main criteria.
That's right. Yeah. And I want to have a certain ratio that's really, really healthy. I write about this actually on my my website. So thesiscapital.com. I put my my notes, my public notes there, and I talk about basically like, here are the ideal characteristics of like the best business. And it's like a big long post that I'm sure no one's going to read, and I'm not really sure anybody has, but it's sort of a public reference also for me to say, like, no, I said this is how I'm going to do things, and so it also keeps me honest.
What's the website? Thesiscapital.com?
Yeah, thesiscapital.com.
I cannot find it. I can see thesiscapital.ca. Oh, there it is. Yeah, we'll include the links in the notes. So the site. So, and where do you have it? You don't have a blog here.
If you go to, let's see here, let me pull it up so I can tell you. If you go to the footer, and then you go to writings, that's where we've got a lot of our notes.
So this is your website, right?
This is my website. That's right.
Okay, so you go to where?
Go to the footer. Go down to the footer, and then go to writings. So right under resources.
Okay.
Yeah, there you go. I should probably make that a training. So, and I can talk a little bit about that, what we provide there.
Oh yeah, that's interesting. Looks like you had some interesting articles. How to be a great investor, risk and probability. I'm looking forward to reading that later. What is the one that you mentioned?
So probably reflection on the nature and characteristics of business monopoly, and then characteristics of the best businesses. So if you scroll down, there's a slider. Let's see. Now you're gonna have to go back to the previous page, and there's a scroll to the bottom of this. So there's, go to 2. Let's see. Did it load the second page?
All right.
Nope.
Well, anyway, you have quite a bit of content, so that's good.
Yeah, this is all stuff that I've written. There's no kind of fluff. It's just so understanding return on invested capital is one of the mechanisms that I'd say is probably the most important thing with any business that I invest in.
Oh, there's not much numbers. I expected it to be like number heavy.
all math. No.
Yeah. All right. Yeah, they're interesting. So you were saying that capital efficiency is a big thing, and also probably an industry that you understand more or less, in an ideal deal.
Exactly.
All right. And would you also look at like personnel and marketing and systems structures that they have in place, things like that?
Yeah, absolutely. I mean, the individual that is running the business, getting the CEO right is mission critical. Yeah. For me personally, I'm going to look at that person, but then also let's go also like the jockey, right? The person riding the horse, and then I'm also looking at the horse. Mm-hmm. And most of the time, what kills a deal for me is the actual horse, right? It's not the jockey. You can have really excellent entrepreneurs, but if I can't understand the business or it doesn't fit sort of my investment criteria and sort of how I understand things and articulate publicly, then I just cannot invest. It's not safe for me because I don't know what I own, right?
Okay. And so what is something that's just a big red flag for you that you would see it and just like no, that you just eliminate right away?
Mm-hmm. So an example is something where you have a customer concentration where you have one customer who represents, let's call it more than 20% of revenue, right? I think you can make justifications and adjustments in a transaction, but if you have somebody who has a business where the business is really dependent on one customer, the probability I think that you're going to run into trouble can be pretty high, and it's hard to mitigate in the transaction structure, right? You could say like in the transaction structure, let's say you have a customer. There's two really clever ways that I've seen to deal with that, where you have a really heavy customer. One is you go to that customer and say, hey, do you want to buy a percent of this transaction because you're a big customer here, right? So that revenue will be recouped. I've seen that done, and then by some really, really smart people. And then I've also seen it where you go to the seller and you say, look, I can't give you credit for this of revenue, because there's so much risk concentrated in this party. But we could work something out where if they stay as a customer for X number of years or what have you, and this problem gets fixed, then we'll pay you some component tied to this. And that's probably the more common structure that I've seen.
Yeah, that's interesting. So I had a very similar case recently on a deal I was negotiating to acquire potentially, and the seller had these two businesses. One business with B2C, and there's a lot of different smaller customers, and one is B2B with only one customer, like literally one customer. And it was actually making more money than the B2C.
Right.
And he says, well, we've been working with that customer for like 7 or 10 years, and he knows him very well personally. He trusts him.
Sure.
So to him, it's kind of like the same value, right? Like the one customer and the million customers, or however many.
Right.
But to me, it's just ridiculous. It's one customer. He cancels tomorrow. There is nothing.
Correct.
So we sort of discussed different ways to value that, and the gap was just like way too big. Like for him, the one customer is like a legitimate business. For me, it's kind of, there is no value. I couldn't really come up with a good structure.
Yeah. No, in some cases, I think you could make the argument that there's no close substitute for what you provide, so that like that big customer really would be in a tough problem if you went away. And I have seen some businesses where like a customer represented a kind of a major share of, let's call it 20-30% of their revenue. And there's like, because I understood the microeconomics, there was no way a new business was going to come in, be able to provide what they provided at the scale they provided it, and knock them off and take this other customer. But those exceptions are very rare, and they have to be basically that exact exception that I described.
Yeah.
And this is a business that did a specialized type of waste management, right? Like, so.
Yeah, and in that discussion, so what we came up with is just to separate it sort of into two different companies, and he would keep the one big customer and sell all the others.
Yeah.
And that made sense transactionally, but the challenge was, of course, that he would potentially stay on as a competitor.
Sure.
So there would have to be some extra restrictions about not competing, not taking on more customers.
Right.
So it was somewhat doable in that sense. Is that a common way to do it as well?
Yeah, I have not seen a transaction like that occur where you've sort of bifurcated, especially with these search transactions. I'd say most search investors sort of want to see the lack of customer concentration. They're kind of pretty dogmatic around the rules, and that creates some problems, right, and some missed opportunities.
Yeah.
But yeah, I think it's certainly a clever way to deal with it, right?
Okay, and what are your thoughts about like trends? Do you try to go with some recent trends in the market, industries, niches that you think are going to grow, or do you prefer things that are just stable, solid, consistent?
Yeah. So 2 points on that. One, me personally, I would, if there's somebody like going towards a trend, I'm just one of these people who like, I go the opposite direction, like immediately. I'm like, I'm going to stay away from this. And usually that produces value, and it's just kind of part of my personality. However, I would say that, especially like kind of our thinking in the B2B SaaS portfolio, is sometimes you're going to have the trade winds blow in a certain way that benefit you greatly, and your best thing to do is jump in the boat and paddle with the wind to your advantage, like with the wind at your back, and paddle as hard and as fast as you can. And sometimes you come up the top of a wave, and that is very much a possibility. But of course, you don't want to do anything that's like you have to be very careful of bubbles. But I'm not speaking of bubbles. I'm speaking of like when new opportunity happens because a new technology is created, or a new way of thinking about things is created. In those cases, you want to jump in and paddle hard and double, triple down, because that's where you'll make the most amount of money.
Yeah, exactly. So like it pays to be a contrarian, but at the same time, sometimes, if you are in the beginning of the trend and it's going to be a big trend, something like VR or 3D printing like 5 or 10 years ago, something like that, then it's good to join as well. But at the same time, often it's already oversaturated, and the the prices and the multiples are already too high.
Yep.
So you have to pick the timing well. Yeah.
Yeah, you can't lose money. Well, you can lose money by underpaying for business, but it's harder to underpay for business, I'd say.
Yeah, it's getting harder and harder now because people are more and more aware of the price. And by the way, how does that pay into the equation? Are you often able to like negotiate prices that are maybe slightly lower, or do you not even bother and just make sure that the structure and financing is better established?
Yeah, so I tell people upfront, like, I'm not going to be the highest priced person, because my typical approach is I lay out for the seller what I'm going to do with the business. Or in the cases where I've advised people, these are typically people who want to hold their business for a very long period of time, and run it just like the seller did in terms of like a family business. And my approach has been to be, let's call it like open kimono, and really just say, like, here's what we're going to do, and we can't do these things if we overpay for this thing, because like we also have use a little bit of probability math, and we show probabilistically, if we have to pay this price, we're going to have to use this much debt, and if we use this much debt, this is the probability that we would die. And I don't think you want that for your employees. I don't think you want that for your customers. And most people, typically understand, like, you can't pay too much. And we want a seller who really cares more about the business than they care about the money. Because if they care more about the business than they care about the money, it's also a business we want to own, right? Now, obviously, they had to have made money with the business. It's not like guys doing balloon art or whatever, but they have to care more about the business than the money and the people.
Yeah, for sure. Especially if they have many employees that they've developed good relationships with, so they would care to keep them on. Yeah. With us it's a bit different, because the businesses we buy, they usually don't have any employees, or they would have just some contractors part-time at that size of like 6 to low 7 figures. So you usually don't have big of a team.
Right.
Yeah. But I also have a somewhat similar approach, just being upfront about what we are planning to do with the business once we acquire it. And we typically look at a shorter time period of like 2 to 3 years before they resell it. So we aim to just to prove a bit and resell and get some profit. And we are usually open about that. And, initially I was apprehensive about it, because who would want to sell their business to someone who is just going to go and flip it? Yeah. So like, I thought that why would you say that? But people are actually quite open to that. Like, they understand that this is what you do. You buy a business, you want to make some profit. So yeah, I found that people are open to that.
And I think structurally, so going back to kind of like that search model, that's what most people are doing, is they're buying, paying in the debt, and then they're flipping it, and basically getting it recapitalized by somebody else. My approach, I'd say, over the last, let's call it 2 years with the money that I've invested, has been more towards hold things for a very long period of time. And like, I prefer to see people not sell that. And it does feel to a certain degree that the market has moved away from that. That's not to say that transactions are not going that way, but it seems like sellers care less about that. So it's part of a wave. I would prefer, all else being equal, I'd prefer to hold some of these businesses forever. So
it's probably because of very cheap debt. So that as the financial situation changes, probably in the next 2 years, I guess the debt might not be as cheap anymore. So the market might change as well. Yeah.
Yep.
All right, very cool. And for what's next for you? Are you planning to acquire any more companies and like run for yourself for a bit, or you just want to look more into this more passive investments with others?
Yeah, I think for me, it's a couple of things. First, it's continue to be involved in this B2B SaaS studio. It's a lot of fun, and we're really helping these entrepreneurs grow their businesses, take them from, let's call it, 0 to hero with their seed capital. That's a core part of my attention. And then I would say that the second piece is I'm very involved with this company Capella as the sort of chief strategy officer. helping them grow that Capella solution, which is kind of a low-code SDK we deployed for a number of firms. And then the third piece is I'm deploying my own capital into these transactions that are these lower middle market, like what I've talked about, both helping build these transactions with these entrepreneurs, but then also I'm spending a lot of time increasingly advising entrepreneurs on how to go do this. So I have a cohort of like 5 people that I advise on how to build a pipeline to go after these opportunities, and then as a result, ultimately acquire their own business, and thinking about ways to sort of expand and improve that. But I think that's sort of the 3 things. I don't know that I have enough time to do anything else.
Very cool. So
at all.
How does the advising work if someone wanted to get you advising them, someone who's looking to acquire a business? Is that how do you get compensated? How does it work?
Yeah, so we have principally found folks through our network. In fact, I had a guy who's even a former intern who ultimately went to grad school and went and did some of this stuff. I'd say, typically my compensation comes in when I'm helping facilitate some of these transactions. What we try to do is we have people pay some nominal fee for people's time, so that way that you're not playing kick the tires, right? So just like a inconsequential sort of hourly rate, and that's it. I mean, like we haven't really done anything else. And then when it comes to actually structure the transaction, then I'll help facilitate the debt, help facilitate the equity, and these sorts of things, and get compensated that way.
Oh, very cool. And have you worked with people who are based outside the US, so people who, would that be possible for people who are not in US to get access to some finance within the US, like SBA loans?
Yeah, so SBA is only available for folks who are acquiring in the United States,
Okay.
At least according to present guidelines. But we have one of the people who actually used to be here in the U.S. In graduate school is actually overseas. He went back to his home country, and so he's a part of the cohort. So I'd say we're just really selective, principally because like I have super limited time right now, which is the biggest. I'd say the biggest limiting factor is actually me. But yeah, we help facilitate financing, and actually there's a surprising number of investors who will invest overseas. So
right, very cool. And you were also mentioning about some deals before, but chatting earlier, you mentioned about some deals that you are looking to do yourself now, like privately. So
sure.
how do you search for these deals these days? Do you go for a specific industry, specific type of business? Do you have like a standard approach for finding them?
I say right now it's really kind of been my network, and saying like, hey, I'm looking at these types of transactions. Like, what do you see? I'm in a bigger metroplex, so I go to a lot of lunches, a lot of dinners, a lot of these things. And I've got some pulled up where I can share kind of like high level what these businesses are.
Sure.
And it's been principally telling people like, hey, I'm looking for this. And I'm telling 1 or 2 people on the regular what I'm looking for. And then people will sort of send things my way. And then also, just like cold email, I'll call people every once in a while just to kind of check in. I've got a list of folks I check in with regularly, yourself included. And say, hey, here's sort of what I'm looking for. If you see things, send them my way. And eventually people, it's just like sales, like people come to know you as the guy who does XYZ, and they'll send you stuff. Yeah. And so that's structurally sort of what I've done. I'd say more recently it's tended towards less cold email, less cold outreach, and more referral from peers and network.
Okay, and how does that pitch sound? Like what do you say that you're looking for?
Just like I'm looking for lower to middle market businesses earning, let's call it like 2 to 5 million in free cash flow, and people looking to sell and people looking to buy them, and anything remotely close to that, just like please send it my way, right? So most of that results in like, hey, this isn't a fit, and here's why. in terms of responses, but when I do get a response, it is generally pretty thoughtful, and people have, to a certain degree, pre-screened, because I'd say a lot of the folks that I interact with, kind of we've talked enough that they kind of know what I'm looking for,
Yeah.
to a certain degree.
So that's very good. So you have other people potentially preferring you some deals. Do you also pay them some sort of finder's fee if that results in a deal?
Yeah, I haven't structured any finder's fees. I haven't structured any fees on sourcing. I know a lot of folks who do that, and I very easily could probably increase my deal flow just nominally and then charge people, and then also pay people referrals, finder's fees. But I'd say I'm at like the first inning of my process where, it's kind of like me doing my thing as opposed to doing it on a larger scale. And but it's definitely something that I need to consider, because I certainly have enough opportunity where I could incrementally increase that, and it would be valuable to some folks, but haven't yet capitalized on that. And I think that in large part it has to do with the fact that my time is very limited.
Yeah. How many deals are you getting now? Like, how many leads are you able to look at on a weekly basis?
Yeah. So I would say I'm probably looking at like 2 qualified deals a week, which is so basically like 100 deals a year. And that is to say that I get a lot of deals that are not qualified, and I screen through those like pretty aggressively. But so it's probably like 2 a week,
And how many do you plan to do or execute out of those 100 a year?
Yeah. Ideally like 2 or 3. Okay. Right. What I aim to do is actually increase that volume and be more selective. That would be better actually, to do the same number of deals, but increase the volume. So all the time I'm trying to think of ways that I can sort of improve that quality without like eating more of my time, but and still probably doing the same number of deals. And the reason for that is that if I can improve the deal set, right, and still do a select number of deals, then my returns in theory should improve.
Yeah. So a lot of that is from just personal networking, like meeting people for lunches, actually physically, not just online. Yeah.
That's right. Yeah.
I guess that's also the industry that you are in is a bit different, because for me it's all online now. Also, because I live in Chiang Mai, there is not a lot of deal flow locally here.
Fair enough. Yeah. Yeah. No, I mean our metroplex is huge, right? So several million people, and so like I could have lunch with a different person every day for a couple of years and still like not meet everybody.
Yeah. All right. Very nice. Well, thanks. That was really interesting discussion. I gotta say I've learned quite a bit about deal structures, quite a bit of new things. So anything that I didn't ask you that you wanted to share?
Well, first, thanks for having me, Michael. Really appreciate it. I would love for people who are interested maybe in the mentorship to check out my website, thesiscapital.com. I am, again, really real just because I have super limited time, but always happy to talk to people who are interested in going on this journey. And then as it relates to the B2B SaaS fund, if you have a seed stage B2B SaaS firm and you are looking for capital in your seed stage capital, I'd highly recommend checking out Golden Section. I'm there, and I'm the head of venture partners. So I sit and advise a number of these firms, and would love to learn more about your business. But we have a great process where you can get more information and sort of fill out some stuff there. And if you need a data, let's call it a data-driven tool to manage your data warehouse needs, talk to me about Capella.
All right. And what's the best way for people to contact you or follow you online?
Yeah, probably the best way to get a hold of me is through my website. So if you go to thesiscapital.com and just go to contact, that's the best way, because it'll go straight to my email. And I don't know, some many years ago, my phone got onto some spam list. So I get a bajillion fake phone calls checking my car insurance, so send it to my email is the best way to go via the contact form.
What is the email?
So go to just go to the contact
site.
form on thesiscapital.com. Yeah.
Okay.
And that'll go straight to my email.
All right. Well, thanks, Ian. Pleasure to talk to you. Till next time.
You bet. Thank you so much, Michael.
And for our listeners, you are welcome to check out our bi-weekly newsletter where we present you with the latest industry news. You can go to domainmagnate.com/newsletter.
Domain Magnet is a leader in buying and selling online businesses with a proven track record of expertise gained from over 300 deals since 2004. To learn more about how we can help you acquire or exit a profitable online business today, head over to domainmagnet.com for more details.